What if I told you the next major financial crisis has already started? Not in the stock market, not in the banks, but inside the very system you sleep in every night. A crisis so silent, so slow, and so well hidden behind headlines about low inventory and strong demand, that millions of homeowners have no idea they are standing on the edge of a financial cliff. In the next few minutes, I'm going to show you the data nobody is talking about, the signals buried in housing markets across the U.S., and the one moment coming soon that could flip the entire market from stability to panic. Because history has a pattern, and right now the pattern is repeating. Set the stage, background, history. Tease to understand what's coming. We need to rewind. America's housing system wasn't built for affordability. It was built for leverage. Mortgages, securitization, adjustable rates, credit expansion. These tools made housing a machine that could inflate wealth at incredible speed. But machines don't run forever. In the early 2000s, this machine overheated. We know what happened next. Subprime loans, defaults, the 2008 crash. But here's the twist. Today's housing crisis is not a repeat of 2008. It's something entirely different and far more dangerous. Back then, the crash came from too many homes being built. Today, experts say the crash is impossible because we have a housing shortage. But what if the shortage is a myth? What if the data hiding beneath that headline tells a completely different story? Keep watching, because the truth is more shocking than the crash of 2008 itself. The origins, how the new crisis began, the origins of the silent crash begin in 2020. When the world locked down, interest rates fell to near zero. What followed was the biggest housing sugar high in modern history. People could suddenly borrow money at 2.7%, even 2.3%, sometimes lower. Buyers flooded the market. Bidding wars broke out for homes that weren't even that special. Prices jumped 20%, then 30%, then 40% in some cities. But here's the cause and effect chain nobody noticed. Low interest rates pushed prices up. High prices locked first-time buyers out. Investors saw opportunity and bought thousands of homes. Inventory collapsed. Sellers refused to list because they didn't want to lose their cheap mortgage. This created an illusion of stability, but underneath it, pressure was building. The rise, how the bubble inflated quietly from 2021 to 2023. Housing entered what economists now call a frozen bubble, a bubble that's inflated but unable to move. Think of ice forming on a lake. It looks solid until one day it cracks. Here's how the rise looked on paper. Home prices hit the highest price-to-income ratio in U.S. history. Mortgage payments for the same house doubled. Investors gobbled up starter homes. Corporations bought neighborhoods. Average Americans became permanent renters. Cities with stagnating wages saw houses jump by 50% or more. But the most important detail was this. The rise in prices was not driven by demand. It was driven by cheap money that no longer exists. When the Fed raised interest rates to fight inflation, this fragile structure started to shake. But almost nobody felt it yet, because the crash wasn't loud. It was silent. The breaking point, the moment everything changed, the breaking point came the moment 30-year mortgage rates crossed 7%. Suddenly, buyers vanished, deal volume collapsed, inventory began to rise. In certain states, sellers were stuck. They couldn't move, refinance, or upgrade. New buyers simply couldn't afford the same home anymore. Homes didn't crash in price. They crashed in demand. This is the key difference. In 2008, prices fell because credit imploded overnight. In 2024 to 2025, the danger is the opposite. Prices are artificially high because supply is frozen. But supply is about to unfreeze. Right now, millions of homeowners are trapped in homes they can't sell without taking a loss. Builders are sitting on new inventory they can't move. Investors are seeing rents flatten while taxes and insurance spike. The market is cracking from the inside, even if prices don't show it yet. The fallout, what's already happening behind the scenes. Here's the part nobody is prepared for. The fallout has already begun. 1. Mortgage delinquencies in several states are quietly rising. Not exploding, but rising in a pattern eerily similar to 2006. 2. Insurance costs in places like Florida and California have doubled or tripled. Some insurers are pulling out entirely. 3. Corporate landlords are offloading properties, not loudly, but steadily. 4. Baby boomers are starting to downsize at the fastest rate in 30 years. This adds subtle pressure to inventory. 5. Credit card and auto loan defaults are climbing when consumers can't keep up with small loans. Housing pain follows next. It's like watching dry cracks spread across a dam. The wall hasn't collapsed, but the pressure is building. Failed fixes. Why the solutions aren't working, every solution attempted so far has failed. Fix number 1. Build more houses. Builders did build, but mostly expensive homes, not affordable ones. These luxury units sit unsold. Fix number 2. Drop rates again. Even if the Fed lowers rates, the damage is done. Nobody who already has a 2.7% mortgage is moving to a 5% mortgage. The market stays frozen. Fix number 3. Rent will cool. The market rents have flattened in many cities, but prices didn't follow. The gap between what people earn and what homes cost has never been wider. Fix number 4. Institutional investors will save us. Many are now selling, not buying. The truth is simple. You cannot fix a housing market built on cheap money. When cheap money is gone, modern parallels, the pattern is repeating. If you look at history, the pattern becomes painfully clear. In 1979, interest rates spiked, gives housing froze in 1990. Regional bubbles burst quietly in 2006. Credit stress cracked the market in 2024 to 2025. Affordability stress is doing the same. The data today is brutal. The average American pays 40 to 50% of income just for housing. The average home is 38% overvalued in many metros. Mortgage applications are at their lowest since the 1990s. Purchase volume has fallen over 40%. Inventory in some states is quietly rising month after month. History doesn't repeat exactly, but this time it rhymes loudly. Ending takeaways. Warning. Call to action. So what can you take from all this? Takeaway number 1. The crash won't look like 2008. It will be a slow bleed, lower demand, rising inventory, stagnating prices, and affordability collapse. Takeaway number 2. The real danger is psychological. When homeowners realize their equity is shrinking, listings will surge all at once. Takeaway number 3. The winners will be the ones who prepare early. Cash reserves, patience, and timing will matter more than ever in the next 24 months. Final warning. A silent crash is the most dangerous kind, because people ignore it until it becomes too loud to escape. And by then, it's already too late. Call to action: natural and educational. If you want to stay ahead of the financial storm shaping America, make sure you subscribe, hit the bell icon, and share this video with someone who thinks the housing market can only go up. The truth is unfolding quietly, but the impact will be loud.